Imagine two friends. Both earn 40,000 rupees every month. The first friend works for 35 years. He saves money in a bank account because he believes it is the safest place. Every month he deposits 10,000 rupees. His money grows slowly, but inflation quietly steals its purchasing power. The second friend also saves 10,000 rupees every month. But instead of letting his money sleep, he invests through SIPs in quality mutual funds that own shares of great businesses. He studies companies, stays patient, ignores daily market noise, and trusts the power of time. After 30 years, the first friend has savings. The second friend has wealth. The difference isn't luck. It isn't intelligence. It isn't a higher salary. The difference is understanding one simple truth. Money grows where businesses grow. Today's book, Common Stocks and Uncommon Profits by Philip Fisher, teaches exactly how to identify businesses that can create extraordinary wealth over decades. This book influenced Warren Buffett so deeply that he once said he was 85% Benjamin Graham and 15% Philip Fisher. If you're someone who wants financial freedom, not by gambling, but by investing wisely, this book can change the way you see money forever. Most people think investing means buying a stock when it's cheap and selling it when it's expensive. Philip Fisher completely disagreed. He believed the real secret wasn't buying cheap companies. It was buying extraordinary companies and holding them while they kept growing year after year. Think about companies like Apple, Microsoft, Infosys, TCS, or Asian Paints. People who invested decades ago didn't become rich because they traded every week. They became rich because they owned businesses that kept becoming stronger. The stock market rewards patience far more than excitement. Let's explore Fisher's timeless lessons. Buy wonderful businesses, not just cheap stocks. Many beginners look only at share prices. If this stock is only 20 rupees, it must have more potential than a 2000 rupees stock. This thinking destroys wealth. A 20 rupee stock can easily become 5 rupees. A 2000 rupee stock can become 20,000 rupee if the company keeps growing. Fisher believed investors should ask one question. Is this company becoming better every year? If sales increase, if profits increase, if customers love its products, if management keeps innovating, then time becomes your greatest partner. Imagine planting two trees. One grows just 1 inch every year. The other grows 1 foot every year. After decades, which tree gives more shade? Businesses grow exactly the same way. Don't chase low prices. Chase high-quality businesses. SIP is the bridge between ordinary income and extraordinary wealth. Many people think investing requires lakhs of rupees. That's completely false. Suppose Ravi starts an SIP of 5,000 rupees every month at age 25. He doesn't try to predict the market. He simply invests every month through market ups and downs. Some months he buys at high prices. Some months he buys during crashes. Over time, this disciplined investing averages out his purchase cost. As India's economy grows and businesses expand, the value of his investments has the potential to grow as well. Meanwhile, his friend waits for the perfect time. Every year he says, "I'll invest after the market falls." Years pass. He never starts. The biggest mistake in investing isn't choosing the wrong stock. It's never beginning. SIPs remove fear. They replace emotion with discipline. They help ordinary people become owners of India's best businesses little by little. Remember, wealth isn't created by timing the market. It's created by spending time in the market. Great management creates great wealth. A company is more than its products. It is the people leading it. Philip Fisher believed management quality is often more important than today's profits. Imagine two companies selling the same product. Company A hides problems from investors. Company B openly admits mistakes, learns, and improves. Which one would you trust with your money? Probably Company B. Great leaders think years ahead. Poor leaders think only about the next quarterly result. Before investing, ask questions like, does management communicate honestly? Do they innovate? Do they care about customers? Do they invest in the future? If leadership is weak, even a great product may fail. But outstanding leadership can turn an ordinary company into an extraordinary one. Ignore daily market noise. Every day, news channels scream, "The market crashed. Stocks are falling. Sell immediately." Fear spreads faster than facts. Philip Fisher believed investors should behave differently. Imagine owning a beautiful mango farm. Would you sell your entire farm because someone offered a lower price today? Of course not. The trees are still growing. Next year they'll produce more fruit. Businesses work the same way. The stock market simply gives prices every second. It doesn't tell you the true value of a business. Temporary fear often creates long-term opportunities. The best investors stay calm while everyone else panics. That emotional control becomes one of their biggest advantages. Long-term thinking creates massive wealth. One of Philip Fisher's greatest lessons is simple. The biggest money isn't made by buying and selling. It's made by waiting. Imagine planting a mango tree today. Would you dig it up every week to check if it's growing? Of course not. You water it, protect it, and trust the process. Investing works the same way. Many beginners check stock prices every hour. If the market falls by 2%, they panic. If it rises by 3%, they become excited. This emotional roller coaster leads to poor decisions. Great investors understand that successful businesses need time to grow. Think of a young company expanding into new cities, launching better products, and increasing profits year after year. These improvements rarely happen overnight, but over a decade, they can transform an ordinary investment into something extraordinary. Imagine two investors. The first constantly jumps between hot stocks, hoping to become rich quickly. The second buys shares in strong businesses through a disciplined SIP, stays invested, and lets time work for him. After 20 years, the patient investor often has a much better chance of building meaningful wealth, not because he was smarter, but because he gave quality businesses enough time to grow. Remember this: short-term trading chases excitement. Long-term investing builds freedom. The power of compounding with SIP. Albert Einstein is often quoted as calling compounding one of the most powerful forces in finance. Philip Fisher believed great businesses create the conditions where compounding can work over long periods. Imagine you invest 5,000 rupees every month through an SIP into a diversified equity mutual fund. At first, the growth seems slow. The numbers barely move. You may even wonder if investing is worth it. But as the years pass, something remarkable happens. Your earlier investments begin earning returns. Those returns can then generate additional returns. Money starts working alongside your monthly savings. This is the power of compounding. Think of compounding like a tiny snowball rolling down a snowy mountain. At the beginning, it's small. But with every rotation, it collects more snow. Eventually, it becomes enormous. That is why starting early is often more valuable than investing a larger amount later. Even if you cannot invest a huge amount today, consistency can matter more than perfection. Your greatest advantage isn't predicting the market. It's giving your investments enough time to grow. Mistakes every investor must avoid. Philip Fisher warned investors about common mistakes that quietly destroy wealth. First mistake: buying because everyone else is buying. Crowds are often emotional. When prices rise rapidly, many people rush in. When prices fall, they panic and sell. Successful investors avoid making decisions based only on the crowd. Second mistake: ignoring the business itself. Never invest just because someone says a stock will double. Understand what the company does, how it earns money, whether it has a competitive advantage, and whether its management inspires confidence. When you understand the business, temporary market fluctuations become less frightening. Third mistake: expecting instant riches. The stock market is not a lottery. It is ownership in real businesses. Building wealth usually takes years of patience and discipline. Trying to get rich overnight often leads to unnecessary risks. Fourth mistake: investing money you may need soon. Emergency savings and long-term investments serve different purposes. Keep emergency funds separate so you don't feel forced to sell investments during difficult market conditions. Wise investing begins with wise financial planning. Practical daily investing habits. Knowledge alone doesn't build wealth. Consistent habits do. Here are daily habits inspired by Fisher's philosophy. Read about one great company every week. Continue your SIP every month, even during market declines. Think like a business owner, not a gambler. Ignore daily market noise unless your investment thesis has fundamentally changed. Review your portfolio periodically instead of obsessively checking prices. Keep learning about investing, business, and personal finance. Stay patient and allow compounding time to work. Remember, small disciplined actions repeated for many years often create extraordinary financial results. Emotional conclusion. One day, you will wake up and realize something extraordinary. Your investments have quietly been working while you were sleeping, while you were celebrating, while you were facing life's challenges. The companies you invested in kept serving customers, improving products, and growing. That is the beauty of investing. You're not simply buying numbers on a screen. You're becoming a part owner of businesses that create value every single day. Philip Fisher reminds us that lasting wealth doesn't come from chasing shortcuts. It comes from choosing exceptional businesses, investing consistently, remaining patient, and allowing time to multiply your efforts. Financial freedom isn't about earning more than everyone else. It's about making your money work while you continue living your life. Start where you are. Invest what you reasonably can. Keep learning. Stay disciplined. And let time become your greatest partner. The stock market rewards patience, discipline, and wisdom, not speed. Buy great businesses, stay invested, and let time transform small beginnings into extraordinary wealth. If this summary helped you understand common stocks and uncommon profits, remember that reading one great book can change your thinking, but applying its lessons can change your life. Every successful investor starts as a beginner. No one is born understanding businesses, compounding, or long-term investing. The difference is that they choose to keep learning. Our goal on this channel is to make the world's greatest books simple, practical, and inspiring. Whether it's about investing, personal finance, productivity, habits, leadership, or building a better life, every video is designed to help you grow one step at a time. If you enjoyed this journey through Philip Fisher's timeless wisdom, support the channel by liking this video, sharing it with friends and family, and subscribing so you never miss future book summaries. Turn on the notification bell because every week we'll explore books that have shaped millionaires, entrepreneurs, investors, and successful leaders around the world. Remember, your future is not decided by today's salary. It is shaped by the knowledge you gain, the habits you build, and the decisions you make over time. Thank you for watching, and until the next book, keep learning, keep investing wisely, stay patient, and keep building a future your family will be proud of. See you in the next video.